So we are here. My name is Michael Abayomi, also known as Springbozz, of course, the CEO, Asset and Equity Group. We will be talking about the MPC today. That is the Monetary Policy Committee meeting held a few days ago, and where some rates are majorly used as a tool or as tools to manage the economic functionalities or functions, basically. One of the three major things that are usually agreed on in the meeting, or discussed or considered in the meeting, would be the MPR. That's the monetary policy rate. This is a rate that most times is fundamental to the outcome of interest rates that is used by commercial banks, private mortgage institutions, microfinance banks, and all other financial institutions within the country or even globally. Most of the time, the monetary policy rate is what is a benchmark that all other rates are, all other rates point to. For instance, a bank would usually want to put up the monetary policy rate and add a few inflationary pressure and maybe a few other risk premium to hit to finalize to arrive at the rate that they more or less issue out to borrowers, depositors, and the rest of the investors alike, as it is. So it was decided that day to be maintained at 11.5%. And what does that mean to the common man on the street? Okay, it means that borrowing from the bank will still remain at the same rate. For instance, if your bank has been lending to you at 20% per annum, for instance, it means you shouldn't expect any form of change in that cycle. The interest rates of all banks, microfinance banks, commercial bank, deposit money banks, as they call it, even the merchant banks, the lending rate will stay static. And if any bank, it keeps you informed, really informed, to the point that if any bank comes up with any frivolous charge on you, charge on any existing transaction, it's easy for you to go at it and question and negotiate even better and all of that. So that is basically what that points to. To an average man, to a layman, you should know that there is basically no change. So your bank have no basis to more or less overcharge you or increase any rates that you guys have agreed on. So quickly, the second major rate that the MPC look at is the CRR. That's the cash reserve ratio for commercial banking. So maybe the banking institutions generally, or other financial institutions generally. Especially if you are in the business of taking deposits, the cash reserve ratio will definitely in one way or two affect you, because what it means is actually that you must hold a proportion of the total deposits that customers bring to your coffers. So you cannot invest all the money that customers bring to you as a bank. That's what the CRR is pointing to. So to the average man on the street, you should understand that this is majorly a function of the CBN trying within the purview of what they do, or within the powers that is being given to them by the federal government of Nigeria to exercise certain duties on its behalf. So the CRR basically is to tell you that not all the money that depositors put in the bank can be spent or can be invested by the bank. So let's put it in a nutshell, okay? So when you take, say, any amount to the bank, okay, what the banks do with the money is they try to convert that money from being a liability into an asset. So how do they do this? They call, if Mr. A brings money to the bank, they call on Mr. B and give a bit of that money to Mr. B in expectation of getting some form of return, that is interest from that. So whenever Mr. A comes back for his money, he will be able to get it and then get it with a few interest. Okay, of course, definitely that's the interest they pay to Mr. A is nothing near what they generate from the asset, the risk assets created with the deposit liability. So basically, what the CRR is pointing to you is that, you know, you are in a way within safe zone. If the CBN is agreeing on 27.5% as the cash reserve ratio, it gives you some level of comfort that not all the money you put in the bank is at risk of getting lost, because not all of them will be converted into risk assets, or let alone maybe other investment vehicles that the bank might be interested. It must be kept in cash or in near cash instruments, and that's the plan. So we talk about the third part of it, which is the liquidity ratio. According to the CBN, it is also a very, very important tool to measure banks' health, more or less the health of the bank, the ability of the bank to meet its short-term obligations. For instance, you're a vendor to the bank, you are a contractor to the bank, you are anything you have to the bank. If you have any business relationship at all with the bank is cushioned in such a way that it has enough liquidity. And for this, the CBN has more or less pegged this at 30% also, just so that any bank in Nigeria should be able to meet its short-term obligation. What do we mean by this short-term obligation? Short-term obligations are obligations that are financial obligations that a bank has to fulfill within, say, 1 day and 3 months. So basically, any bank that gives out a contract, or for instance issues out an LPO to any firm or any individual, should be able to pay back with this kind of ratio being in place. If there is some level of, if there's reasonable level of compliance with all this ratio, no bank has business going down, no bank has any business being liquidated, no bank has any business being closed down. And that is the whole essence of the central bank insisting on some of these ratios, is just to keep you healthy, to keep me healthy, to keep all users of the bank and all users of the industry, and all players in the industry from the shock of, funny surprises that, kicks in once in a while. Although there might be some few pressures in some other institutions, like the recent one that, we heard about some banks which, have failed to comply reasonably to some of the rules and regulations of the CBN, being sanctioned. We've seen board of directors being removed and then being replaced by some other newly appointed ones by the CBN. So basically, the CBN tries its best to protect the fund of the individual or depositors' funds as it is. So basically, that's what the MPC is about. This will be the investment tips section, where we talk about what and what not to do, or the kind of mistakes you shouldn't be seen doing while making investment decisions. Okay, and of course, top tools to use while making investment decisions. So basically, we all want to make investment with our expected return in mind, more or less our return on investment in mind. Nobody just makes investment just for making investment sake. We all know that every investment decision made is targeted towards making a return. So basically, how do we determine a return? How exactly do you know a realistic return from an unrealistic one? It's very simple, and I tell you for good, it's simple. As long as you lay aside your bias and lay aside your greed, and you don't allow these things or these wrong things to get a better part of you or get a better part of your decision making. And then I'd like to take you through some of the fundamentals of making decisions as to what return of interest, or what return on investment is actually normal, which one is outrageous, and which one is totally unreal. Okay, so there are certain factors that are put into consideration when you are calculating interest. They say the risk-free return, and then basically this will be more of a 10-year bond. Basically, that is the return or the yield on a 10-year bond of the government, usually the government bond. And then, of course, another factor is the inflation rate of the economy you're in, of the country you're in. And then if you also look around, you look at some basic risk premium, of course, and few other factors that determine how returns or how your expected return can be actualized or can be determined, if it is right, if it is good, if it is fair, and if it is simply outrageous and unrealistic. Okay, so basically, if you are in a country like Nigeria, where the current inflation rate sits at about 18%, and then your risk premium on a 10-year bond close to between 5 to 8%, and then you have a few appetite for some premium, I say, because of course you are putting your funds in certain investment. So any investment you are investing into that is giving you anything above 20%, I think you should really shine your eyes, like the Nigerian would generally say, the Nigerian connotation, shine your eye. Okay, if somebody is offering you an interest, I'm not talking about a monthly interest or monthly return. I'm talking basically about annual yield. Okay, annual returns. If any investment product is offering higher than 20% and above, higher than 20%, then you really need to conduct some reasonable level of due diligence to it. For example, there is this investment firm that broke the internet recently, led by a 21-year-old who promised investors between 40% to 60% monthly return. For crying out loud, you already know that whoever puts money into this kind of vehicle or into this kind of product, it's not an investor. It's mainly just exhibiting some reasonable level of ignorance. Okay, so you must be really ignorant to put your money in this kind of investment in the first place, and then now you're crying foul, asking how did it happen? Oh, you're being lied to. No, come on, you want to earn 60% times 12. Okay, that would be 720% per annum in return. What kind of investment there? You think if anybody has this kind of solution, they will invite you? Won't they restrict it to their family members and become very, very rich with it? So please, let's not be fooled by. So that will be all for the investment tips for this week. Yeah. So guys, the quote of this week's Monday Money Moves would be: every investment is an asset, but not every asset can be an investment. Let me take that again. Every investment is an asset, but not every asset is an investment. And I'll explain. Cryptocurrency, for example, a very controversial topic, cannot be an investment. As much as we can classify it to be some form of asset by nature, but it has a few or one or two features that indicates or suggests that cryptocurrency is purely speculative asset. And because of that its nature, you really cannot classify it to be an investment. And I'll give an example, or better still, I'll give a professional definition of what an investment is. An investment is that venture that provides some reasonable level of stability of returns, as well as little or no room for loss of capital, or if you like, principal. And that is as referenced in the Intelligent Investor book by Benjamin Graham, 1949. So basically, okay, you have to understand certain qualities that comes with an investment, and you must also be able to identify the qualities that come with an asset. Okay, that something is an asset does not necessarily mean it's an investment. That something is an asset does not mean it's an investment. For instance, you sign an autograph to someone. Of course, at some point it might become an asset to you, but who invests in such? Okay, let's be realistic as realistic can be. Okay, and a very good example of an asset or of an investment will be a federal government bond, more or less a sovereign bond of a nation. You can never invest in any country's bond and lose that money I mean, for how is that supposed to happen? Because every country has the right to its own currency. So in Nigeria has a right to print the naira. So if government is owing you whatever amount in naira, it's so easy for them to go and get some more via printing or getting some more naira in place. But if you invest if you are in the United States of America and you buy their federal government bond, more or less like the United States bond and all of that, you invest in the dollar, you know, all it's going to cause them is to print another dollar to pay you back. They really cannot, you cannot be owed. They can't owe you, okay, because they are in charge of their currency. But what can happen is if you invest with the federal government of Nigeria in US dollar, you see that's, you know, exposes you to certain level of risk. And you know, those are other technicalities to this thing called investment. However, you know, coming back to today's point, that investment, okay, has what it means. There's a clear-cut definition for what an investment should be, and there is a definition for what an asset should be. If an asset does not meet certain qualities or certain features, or it doesn't meet certain criteria, then it cannot be said to mean an investment. Thank you very much. That will be all for the day. Thank you for joining us, and we meet next week for, of course, the Monday Money Moves next week.